So welcome once again. So audit of assets will be split into two, as you would be well aware. I'm picking up the first part, then I'll go to the second part. All right. So because asset auditing is quite broad, so split into two would make a lot of sense. Now, in auditing assets, you know the categories of assets. PPE, lease assets. So here you wouldn't want to say leased asset, but for the sake of understanding, we say leased assets. But you know, we're dealing with ROU, right of use assets. Intangibles such as patents, trademarks, goodwill, inventories, and work in progress, receivables, cash and bank balances. You would realize that there are a number of accounting standards which needs to be understood here. PPE, IAS 16, leased asset, IFRS 16. And then IAS 17, I don't want to go there, but 16 will be enough. IAS 16, IFRS 16 will be enough because it supersedes IAS 17. Look at the intangibles. So you have to understand your IFRS 3 and 10. You know, business combinations, goodwill comes in there. For the intangibles, you also want to look at IAS 38, right? 38. And of course, the impairment of assets itself, IAS 36. Stock of inventories, IAS 2, okay, receivables, cash and bank balances, cash and cash equivalents, okay. So a number of accounting standards comes in here. Cut-off procedures are quite important. And also you appreciate the legal consequences of failing to audit this properly. Okay. So when you look at the learning objectives, it's comprehensive. We may not be able to touch on all. It means that you have to do a personal study, okay, and to read on these things. Remember, lecture slides are summarized. You have to go and dig deep into the expanded text, okay? FRS 102, applicable in the UK and Republic of Ireland, defines asset as what? Anything we hold for use in the production or supply of goods and services, anything we use for rental to others, or something we hold for administrative purposes. And they are expected to be used for more than one operating period, right? Now, in auditing assets, the key things we need to look at are the assertions. Does it exist? Do we own it? Do we control it? Rights and obligations, R&O, okay? Also the completeness. Have we included everything or we've omitted some assets? Accuracy is also important. How accurately we've reported, and presentation is also important. Okay. That's why you always want to see auditors going on what? Observation of inventories to be sure that they exist. And then they will value it. Valuation is also there, okay? Valuation is also there, very important assessment to look at. So the auditor will need to obtain sufficient, appropriate evidence concerning these management assertions of assets. So this process is what we call asset verification. We normally do this through what? Substantive testing. The control testing will look at controls over how we keep and maintain and report and measure these assets. But substantive testing, the verification process is quite detailed, okay? And that's what we normally want to do. Although it's necessary to consider the verification requirements for each asset separately, there are common aspects of each asset which must be verified, okay? You know your accounting equation, right? By implication, audit of financial statement will validate only the net assets base of the business, but also by implication, the result for the period. Okay, so we need these at least to satisfy our accounting equation, the golden rule, right? Many auditing scandals have revealed the failure by the auditors to carry out even a basic verification of some of the assets and liabilities of the company. And the consequences, we know what happens with auditor liabilities. Okay, they end up either undervaluing, overvaluing, or not even disclosing these at all, which is a very serious crime. Now, verification. Cave Bob, you may have heard of Cave Bob, general principles for verifying assets. The cost. Look at the balances from previous year, jive it to the current year balances, okay? Trace it to invoices. If there have been any additions, disposals, trace them to invoices. Who authorized that we should buy this? Who authorized that we should write off the bad debts? Are they in line with accounting policies? What about the value of the assets? Look at prepayments in line with approved accounting policies, independent receivables confirmation, existence. Do they exist? Go and look at it. Obtain independent verification or independent confirmation of these balances from third parties, from the bank, from the debtors, okay? B, beneficial. Look at the title deeds. Do we own this? Is it in the name of the company? The invoices that are used to support the purchase of this. Ownership. Also consider long-term leasing or hire purchase contracts for plants and equipment or plants and vehicles. Third-party confirmation is also important here to confirm ownership of the asset. And are we presenting it in line with the Companies Act and under the required IFRS or generally accepted accounting principles? These are items which will help us to verify assets. Cave ball, okay? Cave ball, the mnemonic cave ball. There are some audit problems and planning when we come to auditing of these assets. Now, importance of pre-planning is important. So at the start of the audit, you would want to send some receivable confirmations to debtors, trade debtors, and to the banks. You would also want to, ahead of time, tell them that, listen, we'll be attending inventory counts. So they will give you their procedures that they use for counting the inventory, of course. Then you have to study it. Now, audit problems requiring audit pre-planning. If we know most of the clients, their year end at 31st December or 31st March. The US system is mostly 30th September. So there could be tight reporting deadlines. So you can imagine if most of your clients have year end on 31st December, you need to get a number of auditors to go and do the counting, the test count, okay, the observations. And again, tight reporting deadlines, because sometimes the Companies House or the regulators would want you to publish your report within the next 6 months or 5 months or 3 months after your year end. So it gives you some pressure on the auditors to do some quick job. Effects of restrictions on availability of staff at year end, like I said, if you have limited staff and you have clients whose year ends are on the same date, that gives you some headache. And then do you also have specialist staff, computer audit staff? Clients may fail to produce information when required. And then when you have a tight deadline to meet, auditors will sometimes end up sleeping in the client's office just to meet tight deadlines. And I remember my experience with KPMG. Unforeseen problems, there could be fraud, there could be power outage, IT disruptions, computer problems. These are issues sometimes you face on the field and it could drive you crazy if you're not careful. Components of assets, we have the non-current, right? Intangible, tangible investments. These are non-current assets. The tangible, you know them, PPE, right? Verify whether they exist, whether we own them, whether the transaction actually occurred, have they all been included, completeness, value them, measure them, do some analysis, some calculations yourself. Have they been properly presented and disclosed in the right place in the account? Now for existence, go and inspect them. Check insurance documents, check vehicle logbooks. Write on obligations, look at the title dates, obtain third-party confirmation from mortgagers, from safety custody holders. Inspect the purchase invoice, the finance lease contracts which have been signed, evidence of any mortgages and secured loans. Inspect the minutes which authorize that these transactions to take place or should be disposed of. Okay. Occurrence. You could get evidence from the minutes, from the board of directors, the purchases, the sales invoices, the lease contracts will tell you that this transaction occurred. Valuation, perform some depreciation calculations, check the fixed asset register and look at the basis of valuation shown. In fact, who is doing the valuation? Is this the professional valuer or the management just tried something out of a trial and error? Check to invoices again. Discuss with directors any diminution of values, check capitalization of interests. Sometimes they could capitalize interest, because assets, expenses all have debit balances, okay? Check for inclusion of overheads in self-built assets. Anyone will want to do that if the person has no good ethical standing. He would want to push expenses into assets. Impairment of value, you would want to understand your IAS 36. I know how impairment is. You look at recoverable amount and value in use, and then you compare them, right? Now, if the recoverable amount is less than the value in use, is impaired. The recoverable amount is also seen as the higher of fair values, less cost to sell, or value in use. So you compare the recoverable amount and then the carrying amount, not the value in use, okay? So if the carrying amount, the net book value, and then the recoverable amount, you compare the two. The recoverable amount, if it is less than the carrying amount, then it's impaired, right? Now for recoverable amount, it's made up of two things. Look at the value to sell minus any selling expenses. Compare it to the value in use. The higher of them is the recoverable amount. So fair value less cost to sell, it like this will cost 10,000. Any expenses related to the direct selling is 1,000. So net effect is 9,000. Then the value in use is actually the present value of future cash flows that will arise from using this asset. So we go back to our time value of money, discounting, present value, you know that, right? So compare that value in use to the fair value less cost to sell. That will give you the recoverable amount, the higher of that. And compare the recoverable amount to your carrying amount, or sometimes we say net book value. And then you check whether it is impaired or not. Now, we also have what we call the CGU, cash generating unit. Goes to a restaurant. In generating food for the customer, there's the oven. Oven will work. Cutlery sets will work. Fridge will work. The utensils will work. Name them. So you see that it's not only the fridge that contributes to the generation of the food. Neither is it only the cutlery or the cooking utensils or the oven. All of them together are classified as one cash generating unit. Smallest identifiable group of assets that generate cash inflows, largely independent of inflows from other assets or group of assets. They together. So you have to look at it. Normally, when you want to impair the CGU, you impair everything. Okay. Impairment of value. Management must indicate if there is any impairment. And you have to use the criteria under IAS 36 or IFRS 11. Now, if a review is carried out, auditors must audit it. Now, recoverable amount may require estimation. Okay, and this is the key area as it may be subjective. Note, if either fair value or value in use is higher than the carrying amount, then value is not impaired. Clearly, right? Then value is not impaired. And the net realizable value is only calculated if there is an active market for the item. If there isn't, then you have to use the value in use to stand in for the recoverable amount. Now, audit value in use calculation. Time value of money comes in here, right? So do some calculation, compare cash flow projections using the budget that they've done or any other financial projections. Look at the long-term average growth rate projected. You have to consult external forces, consult them, analysts will help you. Benchmark this against competitors' valuation of similar assets. If there's an industry benchmark, use it. Now make sure that all costs of maintaining the assets are included. Also ensure that end of life disposable costs are included. Ensure that any cash flows from financing and tax are excluded. Now you compare the discount rate with market rate to ensure realistic and which meets market expectations. The audit procedures, presentation. Ensure they are stated in accordance with IAS 16, right? Ensure assets purchased under leases are separately stated. Don't mix lease assets with what freehold assets. Now, correct disclosures must be shown in terms of valuation, right? Sometimes, and not sometimes, usually we add to assets. We dispose of assets. When we dispose of, we make income. Confirm that any additions are authorized, any disposals are also authorized. I don't just get up and sell the company's vehicle. There must be authorization from minutes of the board. Now, if we buy new assets, check the purchase agreements. If these are leased assets, check the lease contract agreement, okay? Have these been capitalized? Check how much was capitalized. What about disposal? Review the authorization for disposing it. Ensure properly accounted for and disclosure is correct. Sometimes you just have to disclose, not to do the calculation. Review, and in fact, even sometimes when you have calculated, you must still disclose if the disposal is quite material and affects the overall standing of the company's reports, financial statement. Review sales returns and statistics to verify reasonableness of income from patents, trade licenses, okay, franchises. So these are more intangibles. So review these ones and examine audited accounts of the licensees. So for franchises, licenses, who contribute to your intangible asset or income from that intangible asset, review their audited accounts, examine them. There are some key audit points we need to look at. For an asset and its definition, check. Will there be future economic benefits flowing to us as a company? Does the asset if it has a finite life, okay, a definite lifespan, are we amortizing it, depreciating it over that life? If it was originally recognized as an expense, it should not be subsequently reclassified as an asset. So you initially recognize it as an expense. Do not go back and reclassify it as an asset. Okay. If assets are internally generated, they should not be recognized. This is where the pirate criteria comes in, especially for intangible. So any intangible asset generated in-house must meet the pirate criteria. P, probability that it will generate future economic inflows. Okay. Our intention to finish it, to complete it, and to use it. Okay. Intention to. R is that we have the resources available to complete it. Okay. A, we have the ability, the technical know-how, the competency to complete it and to use it. And then we come to what? T, we have the technical know-how, the technology to complete it, to use it, to finish it. And then E, the expenditures associated with this intangible, can they be measured reliably? So if they can meet this criteria, then yes, they should be recognized. Otherwise, they shouldn't be. Self-built assets, check accounting records for correct allocation of costs and that they have been appropriately allocated. Confirm feasibility and viability of the project, review budgeted revenues and costs, review calculations of future cash flows, ensure criteria is still appropriate under IAS 38 intangible assets, check amortization, whether they are charged systematically and whether it commences with production for the self-built assets. There are internal controls you need to look out for. Authorization for purchasing these assets and selling them. The fixed asset register comes in handy. Check whether they've been reconciled with any control accounts. Remember, there are even receivables there under assets. So control account also comes in there. Check whether they've been reconciled appropriately. Control over receipts of proceeds and income from whether sale of assets or from receivables, okay? Any safe custody of the title documents of which cover these assets and whether we've correctly disclosed them in the account. We need them. Leased assets, I wouldn't spend so much time here. So IFRS 16 comes in handy. Okay, so IFRS 16 supersedes IAS 17, where it says that all leased assets will no longer be classified as operating or finance. They will be a de facto presumption that they are all what? Finance leases. And IFRS 16 defines a lease as a contract or a part of a contract that conveys a right to use the asset, the underlying asset, for a period of time in exchange for consideration. So the term right of use assets now becomes more frequently used than what we used to know as leasehold assets. Okay, you will still meet this same thing under audit of liabilities. Okay, that's why I'm skipping over this quickly. I'm just running over this quickly. All right. So like I said, it supersedes IAS 17. Leases are capitalized. They are all capitalized. And here, calculations can be a little bit complex but straightforward if you understand your time value of money, where we recognize the present value of the lease payment, and we will then classify them as leased asset, right of use asset on a separate line in the balance sheet, and then included with property, plant, and equipment. Now, if lease payments are made over time, the company must also recognize financial liability, lease liability, representing the obligation of the company to pay or to make future lease payments. And this will meet it again in the lease, in the audit of liabilities, right? Complications can be associated with the calculation. Calculation can be a bit complicated, but it's quite straightforward if you understand your time value of money, present value discounting, quite straightforward anyway. Now, effects of IFRS 16. Does it apply to almost everyone? No. In fact, items which are of low value, 3,000 or less, or items or leases which are 12 months or less are exempt. We don't normally classify these under leases, right? Now, for companies with material off-balance sheet leases, there is a significant change to key financial metrics. For example, leverage ratios, current ratios, asset turnover, interest cover, EBITDA, EBIT. Why? Because the lease agreement affects all of these ones. So when there are these items quite off balance sheet, they would affect them. And so your audit will have to now go a bit further. Okay. At your level, I don't think anyone will test you on these balance sheet items. You know intangibles. We've mentioned some of them, but I just want to touch on them. Development costs, concessions, goodwill, trademarks, patent licenses, and franchises. All right. If the development cost will not result, if the research cost will not result in the development of an asset, we don't capitalize it. So gone were the days we see research and development. If it does not result in a capitalization, in the production of something, development of an asset, we don't capitalize it. Okay. Key audit points. What you should realize is that will this result in a future economic benefit? Does it have a finite life? Amortize it over that finite life. Okay. If it was originally recognized as an expense, don't reclassify it back as an asset. I'm repeating this. We've seen it already. We're moving it here again. Same principles apply here. Again, if they are internally generated, do not recognize them unless they meet the Pirate criteria. I've explained the Pirate criteria, right? So research simply deals with trying to gain knowledge. Work that helps us to gain new knowledge. Any expenses associated with research, expense it to the profit and loss account. But for development, we use the application of the research findings to develop new products or a new asset. The cost associated with the development, you keep it as an asset. If only we can demonstrate that it is feasible, commercially viable, and will produce tangible economic benefits. If it comes out that the cost, the assets can be sold as it stands presently, as a standalone, and whether we have sufficient resources to complete the project, the Pirate criteria then starts coming in. Okay. Now, development cost, as an auditor, these are things you need to consider. Project completion must be technically feasible, the T under Pirate. Business intends to complete it, the intention, and has resources to do it, the R. Business must demonstrate that there exists market for the product and it is internally useful. That will fall under the P. Only development costs are allocated to the project. Costs are measured reliably, okay? not general overheads, not inefficiencies or losses, okay? Now, amortization must not exceed 20 years. We are using amortization because it's intangible, okay? Impairment of value must also be considered. And the brand values must be made by a competent valuer. Check the qualification of this valuer, not a guesswork by the directors. And they should not amortize it over what they think is suitable. No. Now, any accounting policies used in this must be sufficiently and appropriately disclosed. So amortize the cost under IAS 38, patents and trademarks use the useful life. If it's a purchase goodwill, amortize it over the useful life. Impairment of assets must be recognized when we show it, okay? Brand values must be made by competent valuer, once again, not by directors guessing it. And any accounting policies used must be sufficiently disclosed. Under IFRS 3, you would want to consider goodwill. You know what goodwill is in terms of definition, right? Now look at, in auditing, consider agree the consideration to sales agreement and look at any reasonableness of assets values acquired. You know how to calculate goodwill when you compare the fair value of the net assets against the purchase consideration. Check these calculations and make sure it does not include any non-purchase goodwill, any impairments, amortization to goodwill, review it, and any reasonableness of valuation with directors, consider it and ask them to explain. Consider the useful life of the goodwill and annual impairment review. Usually, currently, goodwills are impaired. Goodwill is impaired, not amortized. All right. Investment, we will maybe end up on this and then continue with the other aspects in the part 2. Investment, those are items we are held for capital growth, income generation, and then IFRS 39 financial instruments comes in handy, right? Financial, so investment could be financial assets, usually. Share capital is a financial asset, right? So valuation rules and the IAS 39 apply. Initially, look at the cost and then subsequently review it based on fair value. I wouldn't want to go into the situation where they are held for future trading and then the transaction cost associated with it and whether to capitalize that or not. That would be more of advanced. I will not hit on that one. But look at the cost and the subsequent fair value. Impairment of the value should be recognized, and then any loans held to maturity investment must be remeasured at the amortized cost. Okay. Now, equity investment, which can't be easily valued, we need to use the cost in reporting. So financial instruments, you wouldn't skip this model without having a very good understanding of financial instruments. You meet them, right? 39 is 39, IAS 9, IFRS 9, I think so. And then IAS 32, you need them. Okay, you need them, right? IFRS 9, then IAS 32, IAS 39, you need them. Financial instruments, okay. So we need to understand the rules governing the financial instruments in terms of its recognition, its measurement, its presentation, okay. Check the existence with documentation, stock exchange listing, company registry, confirm ownership with certificates or with third-party confirmations. All right. So this is what I'd wanted to quickly touch on, but I'll run through quickly for knowledge purposes, okay? So rules for measurement of value. Financial assets which are held at fair value through profit or loss. Normally, they must be held to maturity investments, okay? They are loans and receivables. They are available for sale, financial instruments, financial assets, okay? But those held at fair value, they are normally amortized using the effective interest rates method. For loans, will be amortized costs using, again, effective interest rates and then fair value for any available for sale financial instruments. All right. Okay, so for the valuation, I will leave them and then just for knowledge purposes. But what I will say here is that if you look at IFRS 9, financial instruments, if you look at IAS 32, And then IS 39, measurement and recognition. So 32 is more like presentation. You would get a very good understanding of how the financial instruments work. All right. I would always say that there are questions at the end of the slide. So of the question, Millichamp and Taylor, and it will be ideal for you to assess this or test these questions and get a very good understanding of the text, of the topic. All right. That's it for the first part of assets. We'll deal with the second part in the next section. Thank you. Bye for now.